One ticker, one.
Hello everyone. I'm just trying to get my webcam to work this morning. I'm not sure what's going on with it this morning. Let's see. I'm going to check on YouTube and see if my webcam is coming through. Give me 1 second. Can you hear my voice? If you can hear my voice, please type in yes into the chat, Kathy room. I'm just going to do my task manager.
You're loud and clear, Kay.
Okay, I'm just going to see if something else is using the camera, which I don't think so. Just give me 1 second. Technical difficulties this morning. I don't see anything using my camera. Let me just turn it off and turn it back on. Webcam's already in use. Can't imagine what in the world is using my camera right now. I've only got 5 applications open. All right, Boris, do you want to say good morning? I'm going to restart real quick so that I can get my camera on. Can you turn your camera on and say good morning?
Yeah, just 1 second, just 1 second.
So to let us know, where you're tuning in from. I'm just going to get my camera sorted away. Boris is turning his camera on so you can.
Hey guys, just arrange my camera here. It's a little bit up. There we go. Hi everybody. Hi. Good to see everybody. Really active last couple.
Hold on. I don't see you, Boris. Do you see yourself in your camera? Oh, there you go. Great. All right, I'm gonna leave and come right back.
Okay, all right, talk to you later. Hi guys, so I'm gonna just keep you a host for just a few minutes before Kay comes back. A lot of really cool things going on in the markets today. Actually, a lot of cool things went on in the markets the last couple of weeks. We've had lots of big movements, both in a dollar and equities and gold. Opening up this morning, it's going to be, I think, a much quieter week because we've really had most of the news flow occur last week. We had the FOMC meeting, we had the non-farm payrolls, markets kind of absorbing a lot of information. A while back in our BK Traders Telegram group, which is absolutely free, I'm actually gonna, when Kay comes back on and I have a chance to grab the URL, I'm gonna post that URL. So for those of you who are watching us on YouTube and do not have the access to the Telegram group, please join us because we post a lot of free content in there at least twice or three times a day. And one of the things I posted last week, which I thought was really interesting, was the study about sell in May and go away, right? So sell in May and go away is kind of like the standard trading maxim of like markets underperform between May and October. And it's actually very true. On that 5-month basis, that is the worst performance of any 5-month basis. So if you were going to go like, you know, January to May, February to June, you know, on a 5-month roll, by far the worst 5 months historically since 1950 have been May through October. However, this is the interesting thing. When you look underneath the hood, where the real trouble is actually in the month of September. September is by far the worst month ever in the stock markets. That always causes all that turbulence. So a huge part of that May to October, you know, sell in May, go away dictum is really a function of the September sell-off. That doesn't mean that things are really great in the summer. They usually tend to be mediocre, but mediocre doesn't mean that, you know, they're bad. There's like 1 or 2% gain in the S&P usually during that time. So it's just interesting to understand how the data sometimes can conflate the underlying reality, and it's important to know to understand those numbers. So Kay is back. I'm just telling him a little bit about sell in May, go away, because there was an interesting study that we did that I posted in our BK Traders Telegram channel, which I'm going to just give a link to everybody. We don't hear you, Kay. We just need your.
Yes, sorry about that. I'm just getting everything kind of reorganized. But yes, please send them the Telegram channel. Are you guys looking at my screen? That's okay.
No,
I just grabbed the screen.
You gotta grab the screen because it says I'm the presenter now.
Okay, but in the meantime, why don't you share with them the channel? Thank you again for your patience. I just had technical difficulties, and my camera was being used by another software, so I'm just kind of logging back into everything that I need to log into this morning. But yeah, I mean, seasonality is important. I think seasonality, some people, you know, really disregard it and they don't think it's that significant, but I think, you know, it's definitely something that a lot of people watch, and it's far smarter, in my opinion, to skew yourself in the direction of seasonality, meaning that it's sell in May, go away. It's probably much smarter to sell in May and go away for, it's much smarter to look for opportunities to sell than to look for opportunities to buy. Okay, I think I'm squared away. Boris, can you confirm that you see my heat map?
Sorry, hang on. Yes, now I see the heat map, yes.
Fantastic. So if you want to go off screen for a minute, I have everything up and running again. So thank you everyone again for your patience. So let's talk about this coming week. Last week was obviously a very, very big week in the markets. We had FOMC, we had NFPs, and then we also had the ISM services index, which normally is not that market moving when it comes out after NFPs. But the fact that it was so unexpectedly weak, the fact that the ISM services index dropped back below 50 for the first time in a year. And for those of you that don't know, the 50 is kind of demarcation level between expansion and contraction. And I can show you that all over here, which is, sorry, on Friday, we had the ISM number, and ISM services 49.4, the weakest ISM services numbers in more than a year. So if it's above 50, it means that the service sector is growing. If it's below 50, it means that the service sector is slowing. So this is the first time we are seeing evidence of service sector activity actually slowing since in more than a year. So I mean, this is a pretty big deal. This means that we're definitely seeing we're seeing this non-farm payrolls number possibly show signs of a deeper slowdown, possibly show signs of a possible, further contraction going forward. Now, we don't know yet because this is only 1 month of weakness. This is the first month we've seen non-farm payrolls really surprise to the downside in a very long time. And at first, when it was just the NFP report, I don't think the market really thought too much about it. But then the fact that it was followed by this terrible ISM services number, then that's when the red flag really triggered. Now, still, I don't think the Federal Reserve is going to be swayed by 1 month worth of data, and that is probably the one of the main things that I think everyone is focusing on, because 1 month worth of data, the Fed is definitely on the Fed radar, but they're much more sensitive than that. But as you all know, the dollar has sold off. I mean, it's still selling off, except for against the Japanese yen, which we'll talk about. But the dollar has basically sold off against all of the major currencies, because first you had FOMC. And with the Federal Reserve meeting, we talked during the week with BK members about how he really didn't say anything particularly dovish. The fact that he ruled out a rate hike, which, you would be delusional to think that the Federal Reserve could actually raise interest rates this year. The fact that they ruled out an interest rate hike was enough for the market to end up selling dollars. Everything else he said did not necessarily indicate that they were closer to lower interest rates. But what really mattered was the data. First it was non-farm payrolls, then it was the ISM services data, both of which kind of put 2 rate cuts this year back on the table. So that's what I want to look at with you, because this week we actually don't have any major U.S. economic reports. So what happened last week will kind of continue to drive U.S. dollar flows. So we already know nothing for June is anticipated, and the odds didn't shift much from Friday, 91.6 to 91.8. July, on the other hand, we've seen a bit more of a flip, where on Friday it was 65% and now it's 63%. A week ago it was 70% chance that rates were going to remain unchanged. Now there's a little bit more of a chance that it could be lowered, but September is where things really, I think, show a bit of a change, where now the market is pricing in a 70% chance of an interest rate cut. And in general, the market is now pricing in 45 basis points of easing. So one rate cut is, so you can see this here, basically by December, there's only a 8% chance that rates are going to remain at current levels at 5.25%. So that means there's a 92% chance of at least one interest rate cut. And on the full curve, the market is pricing in 45 basis points of easing. So that means one interest rate cut is fully priced in and almost a second. And so this is quite different from what we had prior to the NFP report. Now, it's important to put this into context. And yeah, I didn't get a chance to post this as a post yet. I'm not sure how I'm going to do it, but what I want to share was that basically there's 45 basis points of easing priced in for the Fed this year. And I want to share with you the euro dollar chart. There's 45 basis points of easing priced in for the Fed, and there's 60 basis points of easing priced in for the ECB. So that means that there are 2 full interest rate cuts priced in for the ECB and about a 40% chance of a third interest rate cut. So what does that tell you when you're looking at this chart here? This tells us that euro, in particular, will continue to underperform a lot of the other major currencies like Aussie, like Kiwi, like maybe even the British pound, but we'll have to see. But in general, the ECB is still very much going to look at lowering interest rates as early as June. A June interest rate cut is still very much on the table. And because a June interest rate cut is still very much on the table, I think that euro is going to be sold on rallies. This week, we have two central bank rate decisions, the Bank of England rate decision and the Reserve Bank of Australia rate decision. The RBA rate decision comes first. Aussie is very strong, as you can see here. Aussie is trading at its highest level in 4 months. And like the Fed, the market's kind of delusional in its thinking for the Australia. The market thinks that the RBA, the market is pricing in a tiny, tiny chance of a interest rate hike by the RBA. Of course, we know that's absolutely not going to happen, but it at least tells you that there's zero interest rate cut priced in for Australia this year. So this could go one of two ways. The first way is the market be absolutely right, and the RBA, when they meet, they will say that they previously dropped their hawkish bias, and they're thinking about possibly they're on an easing bias, but they could say that inflation is still too high. We are still not necessarily thinking about lower interest rates yet. And if that's the case, Aussie could find itself trading much closer to here. Well, maybe that's kind of exaggerated. Okay, probably much closer to here. But data from Australia also hasn't been that great. We have jobs numbers that were slightly weaker. We have also the inflation data was slightly lower. PMI numbers were slightly lower. So there is still a lot of reason to think that there could be a possibility of the RBA being less hawkish, slightly more dovish. If that's the case, we could see this rally start to correct. Ultimately, because RBA rate decision is tonight, we're only going to be able to trade it after the fact, because it's not like it's many days away and we could be buying Aussies in anticipation of it, and then squaring up before the rate decision and then taking a reactive trade, which is something we often do at BK. But because it's tonight, there's really no wiggle room, right? So we just got to wait for the RBA to meet, to say what they want to say, and then take the trade. And this would be more of an opportunity for Tuesday night and forward. But I do believe that when the dust settles, unless they say something uber dovish, that Aussie is, because they're going to look to lower interest rates later than the Fed and the ECB, is still going to be a buy against euro and US dollar. The other rate decision that we have this week is the Bank of England's rate decision. Now, the market is pricing in 50 basis points of easing this year from the Bank of England. And there's a 50% chance that could happen in June, which, is a pretty good chance. But more likely, the first interest rate cut is going to happen in August or September. Pound is well off its lows. Data, which is kind of surprising, because unlike Eurozone, where we've been seeing signs of stabilization, UK data hasn't been all that great. So the Bank of England has a rate decision this week, about 50% chance of a early summer interest rate cut. So we're very much going to be listening to what the BOE has to say. BOE rate decisions on Thursday, so we've got plenty of time. And that's, and then the GDP numbers come after that. I think so far from what we've been seeing and hearing from the BOJ, it seems like they've been more or less resisting a interest rate cut. So if they are resisting an early interest rate cut, then I would have to say that that's probably something that is more or less going to be something that's more or less, I think, going to be a situation where they don't say much and maybe just say the market's properly priced in, which could actually end up being positive for pounds. But the levels to watch in pounds are 126.50 and then 125. If it clears 126.50, then there's no major resistance to up in this region here. If it breaks below 125, then it's kind of free reign down to here. So we'll have to see. The BOE rate decision is fairly important. But overall, I have neutral dollars because the thing is that we don't have any major US data this week. And the data that we have had from the US has been showing signs of weakness. US yields, I think that, this the reason why dollar yen has peaked is because US yields have peaked. And we looked at this before, and we'd like to look at this every Monday. We like to look at, let me just move this to the left. We like to look at this every Monday. And I've said often that when US yields peak, that's when dollar yen has peaked. And it seems like between the peak in US yields, the turn in US data, and then also the rise in volatility in Japanese options futures, combined with the persistent physical intervention from the BOJ, from the MOF, and them indicating that 160 is the line in the sand. I think we've seen the top. For all those reasons, I think we've seen the top in dollar yen. And I think that, dollar yen could rally a little bit, maybe. But I think that overall, it's, we've probably seen a top, and then we're probably going to see a bit more further weakness. Definitely, I think this congestion zone over here, which is around the 151 level in dollar yen. So a lot of you asking about dollar yen, and I think we've definitely seen a peak. I think sell on rallies. If we bring back my moving averages, you will see that there's pretty significant moving average resistance, right? This cross over here at 154.50 or so. That would probably be around a good place to test, watch it test, reject, and then sell again for dollar yen. So neutral bearish dollars just from a flow perspective, but from a fundamental perspective, U.S. economy, I think, is still, performing really, really well. And I think overall, it is something that, is going to drag or follow through into this week from last week's flows. Euro, I'm neutral because as I started earlier, I said the ECB is probably going to be one of the earliest next central banks to lower interest rates. They won't be the next. I mean, this Sweden central bank is expected to be next, but between the ECB and the Bank of Canada, one of them is expected to lower interest rates. And that is why I think Euro crosses will remain weak. Like Euro Aussie, Euro Kiwi, we'll have to see what RBA says. So we always, kind of react to what the latest developments, even though we may have a broader fundamental view. So with the RBA, if they are less dovish or they maintain their current stance and your ECB stays where they are, then Euro Aussie could have further downside. Pound, I'm still bearish overall because, they data has been bad. So if they could lead one way, it would probably be towards dovishness. So we'll have to see. Aussie, I'm bullish. As I said, there's no interest rate cut priced in this year. In fact, the market is delusional enough to think that there's a small chance of an interest rate hike, which obviously we all think is not going to happen. But still, that is what the market is thinking. Canada, neutral. We have a lot of CAD data this week. We have IVPMI, we have jobs report, and those are very, very important in setting the stage for the next move in the Canadian dollar. Now, I would think that it was most likely going to be negative given the strength that we've seen previously, but we'll have to see. But overall, I do think that there's probably a bit more downside than upside to the CAD this week. So, but oil prices are up today because it seems like ceasefire talks are not working out in the Middle East, and so oil is supporting CAD, but still. But we'll watch IVPMI come out tomorrow. That'll give us a really good leading indicator for how the jobs report will fare, because IVPMI has been very high. If it starts to fall in a more meaningful way, that obviously is a problem. New Zealand, I'm neutral. There's only New Zealand business PMI later this week, and there's not as market moving, so it's going to trade in Aussie flows, going to trade on dollar flows and euro flows. I'm bullish Swiss francs, and this should actually say bullish. I don't know why my card didn't update. I'll have to fix that, but bullish Swiss franc, bullish yen. We actually have really hot inflation data from Switzerland recently, so that should keep Swiss franc outperforming. No major Swiss data this week, and the yen, you know, like I said, the persistent intervention, I think is going to continue to, you know, lift up the currency most likely, and you know, for all the reasons that, you know, we talked about. All right, so now let's take a look at the eco calendar and go through everything that is important to talk about. So yesterday we had Aussie's also one of the best performers because we had stronger job ads. Chinese data was better, which is a bit surprising because we've actually been seeing improvements in Chinese PMIs. Eurozone, today's a holiday in Europe, Japan, a couple other countries. And so the liquidity in the markets is thinner. We had upward revisions in Eurozone PMIs. We have no major data today from the US. Tomorrow, we have tomorrow, we have a lot going on. We have the RBA rate decision. As I said earlier, the market is delusional enough to think this is an interest rate hike. You know, obviously, not tomorrow, but this year. But I think they're going to try to talk that down. If they don't, then that's going to be widely positive for the Australian dollar. If they kind of maintain the same statement and the view that inflation is still a really big problem and showing no signs of progress, that's going to be a really, really big problem that could drag that could drive the Aussie higher. But if they start talking about the weakness in the labor market, being a bit more proactive, inflation starting to make progress, that is going to be Aussie negative. We also have a Swiss unemployment numbers, German trade numbers, which will probably be better given the stabilization we've been seeing in Eurozone data, as well as Eurozone retail sales. We have a nice bump up at German retail sales. So we expect to continue to see signs of stabilization in Eurozone data. But even though we've seen stabilization in Eurozone data, it does not seem to really matter for the ECB, who continues to say that a rate cut in June is on the table. And they've been pretty explicit about that. Wednesday, we have German industrial production numbers, which we'll have to see how tomorrow's factory orders report fares. And then we have nothing for the US, absolutely nothing on the calendar for the US this week. So I think last week dollar flows will continue and to carry over to this week. Chinese trade data, always interesting to watch. And then on Thursday, we have the BOE rate decision. And this is one of the main events this week. BOE, if you missed the beginning, I said the BOE is pricing in 50 basis points of easing by the UK central bank this week. And so this is about the same as Fed, a little less than the ECB. So if they say the market's appropriately pricing easing, that's going to be probably negative for euro pound. If they increase their dovishness, express concerns about growth, that's going to be positive for euro pound. And I may be looking for trading opportunities in euro pound as a result of that. And then we have business PMI from New Zealand, probably going to be a little weaker. And then on Friday, we have UK GDP numbers. That's expected to be a little stronger because trade and retail sales improved in Q1. And then from Canada, we have their jobs numbers, a little bit of bump up expected after a drop the previous month. And then US consumer confidence, which should be a little weaker because we had that weaker non-farm payrolls report and stock report. So, that's basically what I'm looking at on a technical basis. Euro, we talked about how it's meeting a lot of resistance. I think right now, because I'm bearish dollars, I'm also bearish euros. That's going to be a bit of a tougher call. We'll have to see how the flows are. But I think euro is still a sell on rallies. Pound dollar, it's going to be up to the rate decision. I think it's going to grind, ahead of the rate decision. And I'm not going to touch that beforehand. Dollar yen, I think it might bounce a little bit more and then pull back. I think we've seen the peak in dollar yen. Dollar Swiss, I think is going to pull back further. That's going to be, probably an easier ride lower for you dollar bears. Aussie, we're going to have to wait till tonight's rate decision, see how that fares. But I think, there should be some big moves after the rate decision. Kiwi, I am neutral Kiwis. I think that if we get clear above 60.50, we should see more gains. But overall, we'll keep on watching the charts. And then dollar CAD, we've got IVPMI tomorrow. Oil prices are up today. So right now, I think we could see some further downside in dollar CAD. All right, now I'd like to open up the floor. Any questions? See if anything you guys want to ask. Let me know. And otherwise, I'll let Boris chime in the thoughts on gold and the other markets. Any questions? Boris, you want to come on?
Yep, I'm going to come on right now.
Okay.
Just one sec, guys. Let me just get my camera. Hey, guys. All right. So I'm going to grab the screen. Just one sec. Change presented to me. I'm going to show screen 3. Okay, let's make sure you guys are seeing my screen. Yep. All right, let's talk a little bit about equities, gold, and oil. On the equity side, this is obviously a very, very short-term chart of NASDAQ, but everything on the equity side is kind of a mild bid rally into the open today as a continuation of what happened on Friday, excuse me, which was a really strong day post relatively weak non-farm payrolls, which really convinced the market that rates are going down. I think the markets are still so far trading on positive fumes. And the fact that today is going to be, I think, an interesting day in NASDAQ, because to me, it's going to be a question of whether we can hold this 18,000. I'm actually going to go to the futures side, because the futures is the key level for us. Right now, the futures are holding above 18,000 in NASDAQ. If we hover above that today, close above that, that still remains to be a positive bid story, in my opinion, on NASDAQ. If we look at our analytical table, it shows us that we're bullish already for 3,700 1-minute bars. So really, like 4 or 5 days already been in an upward trend. Range today is relatively small, 49 basis points, but generally still a positive move in NASDAQ. I think similar type of story in the S&P. A little bit of younger trend in the S&P, a little bit more muted move. But with the S&P, the big story was everybody was afraid that we're going to take out the 5,000 level. It actually came up the opposite. We took out the 5,100 and now sort of gunning for towards the 5,200. Now, I will say this is interesting. There's a lot of people, as a matter of fact, I would say most people are completely convinced that the market has peaked, that we have a double top, or we have a top in equities, we have a top in NASDAQ. So there's nothing more painful and therefore more likely than for the market to just pop all the way up to be above 5,200, take out the S&P top, squeeze everybody, maybe even up to 5,300 before curling over for the rest of the summer. So to me, the pain trade, which is always the more profitable trade, should be the trade towards the upside, and should be watching that very carefully. Can they squeeze them all the way up to the 5,200s on the S&Ps? Can they take them out at the 1,800, 18,100 in the NASDAQs? That's going to be super interesting for us to watch as far as that goes. Gold, on the other hand, had obviously a big corrective move. Gold really sort of just came down off the 2,450 level. But here's the interesting story. Gold really holding this 2,300 bid. Now, there's an enormous amount of super interesting, what I call alternative fundamental stories in gold. One of the more interesting things that I read over the weekend that I think is fascinating if you are a gold bull these days is the irony of the whole thing with the U.S. needing to finance very, very large trade deficits, right? The U.S. actually needs foreign capital to buy treasuries. It needs demand for treasuries, right? Now, if oil is priced in dollars, people have to sell treasuries to buy oil. So unlike in the past where U.S. was adamant about pricing oil in dollars everywhere across the world and imposing that mandate, including, during the Iraq War, which was really a mandate really all about pricing U.S. oil in U.S. dollars. U.S. is actually, I think, tactically, this poster was arguing U.S. has tactically changed his opinion and is actually at all completely happy with Indians buying oil in rupees or even the Chinese buying oil in the yuan, as long as they therefore not sell their U.S. Treasuries, and then obviously not have any pressure on the Treasury as far as yields go. So the complement to that, the second order thinking of that, is if you are buying oil in your own currency, then gold becomes the neutral settlement currency. And maybe that's one of the reasons why gold is actually starting to really percolate as a store of value. I thought that was an interesting story. I thought definitely gold and oil kind of go hand in hand. In this case, though, the whole dynamics have kind of flipped, where U.S. is perfectly okay with other people trading oil in non-dollars as long as they keep their treasuries on board and don't flood the market with treasury sales. So super interesting. Certainly, technically, we're acting pretty well. Bounced very, very hard up this 2,300 level. Gold really looks to be, a positive bias, as you can see on my 1 minute charts. It's all rockets all the way to the upside. Oil, on the other hand, now this is the interesting thing to me. Geopolitically, this is probably the single most important thing. If you want to see stocks go up, if you want to see global economy continue to perform, the single best thing you can hope for is that oil stays below 80, stays in the 75 or 75, 85 band, and that you see nothing but dumpster fire sales on oil. Because oil going up is the single most inflationary, single most contractionary, single most difficult thing for global economies to absorb. Remember, foreign governments have to actually import, the rest of the world imports oil, so the higher oil goes, the higher it is for them. If they have to do it in US dollars, they have to buy it in, even more expensively. So the whole idea of oil kind of staying in this 85 to 75 zone, despite all the turmoil in the Middle East, it feels like, ironically enough, the more turmoil there is in the Middle East, the more Iranians have to pump oil just to survive, and the Russians have to pump oil just to survive in Ukraine. So there's a flood in the market. Clearly, the embargo is circumspect at best, and that's actually creating a nice flood onto the market in oil. Oh God, sorry, I have to just sneeze for a second. Just bear with me a second. Okay. And therefore, this is probably the single most positive macro variable that we can think about. As long as oil stays 85 to 75, we muddle on through. We start seeing oil go to 85, 95 end of the summer, or even, God forbid, breach 100. That's a much, much more dangerous situation for the global economy, global geopolitics, and everything else that comes with it. So leave you with those thoughts. I'm going to be live trading in about 15 minutes in our room. For everybody else, we will be live trading. We're back in business. Live trading tomorrow. Live trading on Wednesday, 9:15 to 10:30, maybe 10:45. We'll go as long as we need to. We're going to trade gold and indices. May even trade a little bit of oil too. I may just put in oil in the rotation, because we're going to show you all of the techniques we use to be able to trade these instruments in our room. Looking really, really forward to it. So I'll see you guys later.
And actually, for those of you that are asking about 8cap, how to get ZIP as a part of 8cap, I'm just posting the link onto the YouTube live stream. So make sure you take a look at that if you want to get, all of our indicators and everything. There's, a lot of information on this page. You get it all free as part of being a member of 8cap.
Yeah, it's a great deal. We just had 2 customers come in today. You can get literally everything that we're showing you, all my live trades, all of Kathy's FX calls, everything for nothing, for free, just for opening an account with 8cap, which you would do anyways if you're a trader. So definitely take advantage of that deal. If you are a non-US or non-Australian resident, this is a deal that's available to all of the rest of the world. So please take advantage of it if you can.
Okay.
Otherwise,
thanks so much.
Yeah, thanks a lot, guys. We'll see you in the markets. I'll see you tomorrow for live if you want to join me on YouTube. I'll see you guys later. Take care. Bye.